Congratulations, you're working on your final project and paper in our MBA finance class. Wow, what an amazing job that you've gotten to this level. I'm so proud of you. Go ahead and just pause the video and uh, take a moment and pray and thank Lord for giving you the strength to do this for the last 8 weeks, and just so that you can continue in your education so you can prosper in his glory. Go ahead and do that for me and take that minute and really thank God for everything that he's helped you with in the last 8 weeks and able to gain this class complete. All right, after we've prayed for that, I'm hoping that you reflect on all the great things and God's glory. Let's go ahead and get started on this case study. If you haven't read the case study, go ahead and download it and purchase it from the Harvard Business Review. You can find that on the syllabus as required text. Also, go ahead and jot down the questions that we need to ask. All right, if go ahead and pause it if you haven't read it. If you've read it, let's continue to go, and let's start with our first question. What are the financial implications of Ferrari's current strategy? Well, basically, Ferrari is going to be making new cars, and they want more cash infusion. What's happened is that the Asian markets have become more wealthy, and the designers for important cars of these exotic cars in there. Going to be looking at that Asian market that has increased in there. So what they want to do is they want to increase their production 9,000 units per year. That's a big amount of units that Ferrari is going to be increasing. This isn't a luxury like brand that is just manufacturing these cars through some huge automation process like Ford or GM or Dodge, Honda, or even Mercedes Benz. These are more of a specialty car, exotic car. And so what they want to do is they want to introduce 17 million new Ferrari shares, and they want a cash infusion. Now remember from our case study, what happens here is that there's three ways that a corporation can raise capital. So they can either raise it through stock, bonds, which is borrowing it, and then also the last one is through revenue. Well, in there is that they're believing that they can sell a piece of their company in the stock and get millions of dollars in the shares. So, in that is, are they going to want to sell a piece of their company today to have a greater value of their company in the future? And that's why they're willing to sell some of their shares in order to do that. Now, companies that aren't willing to do that will sometimes not grow at the faster rate because they cannot receive that cash infusion. So the question here, or the real question is it important to sell a part of their company so that they have a greater influx of cash today so that it's worth more? Another way of looking at it is, if I own 70% of my company, is 70% of my company worth more than 100% of my company if I sell 30% of it so that I can grow that company in doing things? So that's what they're looking at right now. They're really trying to go into those Asian markets and trying to get going on those. So let's next look at, do we agree with the financial forecast in Exhibit 8? If so, why? What are specific concerns do you have? Do you believe they can grow that much? A lot of their growth is in there. They're saying some parts that they can grow 7%. Do you really think that that's going to be able to influx? Is those markets in there? The other things that we have to look at here is look at operating profit of all other revenue. Okay, this is outside of cars. Ferrari has done an amazing job in selling the brand of Ferrari. Well, most of us can't afford to have a Ferrari, or if we bought a Ferrari, maybe we couldn't afford the maintenance, or we didn't want to pay the maintenance, or maybe we just really like the brand Ferrari, but we don't want to have a car that's worth $300,000 and then it gets crashed on the 91 or something, and or you're worried about something like that. Well, in there is that you can own a t-shirt, a pin, you can have a backpack, you can buy socks, you can have all these other things that are operating profit other than revenue. So the brand that themselves that are selling in there is amazing. Well, in there is, do we have concerns? Yeah, we have concerns, and I'm going to put shit together um, in here. Two companies, Michael Kors versus Burberry. Okay, Michael Kors took the discount strategy. What that means is that they said, you know what, it's more profitable for us to be everywhere in the world and have our brand in there. So Michael Kors could have kept their items rare and kept them at a price point. When Michael Kors first came out, a purse in the women's clothing line would have cost $400 to $600. Now, in that time frame from when they first started out to today, you can pick up in a discount store like uh, Ross or Nordstrom's Rack, you can pick up a Michael Kors purse for about $90 to $100. Why are they discounting their product? Because it still provides profit. The same strategy that Tommy Hilfiger did with its outlets. Now, Burberry has done something completely different. What Burberry has done is they said, well, we want to keep, or Louis Vuitton, you can decide whatever luxury brand you want to put in there, that they decided to keep their prices artificially high, keeping them rare, saying that, you know what, if someone owns a Burberry, I know that they spent $700 to $800 or even more on that purse. If it's a Louis Vuitton, $3,000 probably minimum for that purse in the women's collection. Why do they do that? Because it's rare. It provides value to the company. Is that going to be saying that if we grow at the 7 or 8%, the concerns that you have is the value, because there's more items, supply and demand of those products, that is it going to bring down the value of the brand of Ferrari because more people bought it? And we can look at their sister company and see that Maserati has done that, as that they brought down that, made the car more affordable for people to purchase, that the value of Maserati has gone down in some way, in that regard that people are paying less for it than they would have maybe 10, 15 years ago. But there's more supply, more of them on the road today. So look at that and see how much, if you think they can grow there. There's no specific math that's going to go in there. It's just how you feel. All right. I went ahead and I did this model and valuation for you, and it comes out at $38.25 a share. I put in there the euro exchange rate to United States that we can get in there. You can do this and look at it and see that, if, what do you think it's worth? This is it based off of that. So use the sell price as $38.25 and then tell me what you think Ferrari is worth. Now, in there is that when you have an IPO such as Ferrari, of course, is going to have some type of hype, some type of talk about it. People are going to say Ferrari is finally open for business, or finally being able to purchase it. Maybe I'm just a fan of Ferrari and Ferrari racing, and I love Ferrari, and my dreams to have a Ferrari. So I just want to buy a couple shares of this Ferrari stock so that I can own it. Yeah, that happens a lot of times in that regard. So do you think that Ferrari's worth 38.25? I believe that that's what the market is, but probably not what it's going to come out at. It's going to be worth probably more in the market because it's a higher end, well-known brand. So in preparation for Ferrari's listing on the New York Stock Exchange, which is a big deal, a lot of companies don't get into the New York Stock Exchange right away. At what price in the US dollar would you recommend Ferrari shares be sold? When Ferrari first came out in that 2016-2015 timeframe, it was listed just over $50. And as you can see, the last couple of days here, or the last couple times, it's listed at $168. So if you bought Ferrari at that IPO, which a lot of people did because they knew that the property of Fret in there is going to happen. So what happens is, was it worth it to buy it? And you can see at the dip here in our little market that it did go down about $30 in there. So inflation by name. Is that going to happen in this case? Yes, we saw it. The numbers told us the stock's about $40. They priced it around $55. And what happens is that they knew that the name of Ferrari was going to cause it, a point in there. In here is that we also have a winner's curse, is that sometimes they'll lower their price in there so that they did it, and then maybe they'll have a lawsuit avoidance that they were overpricing their IPO price, and they get in there. Bandwagon and loyalty, just kind of similar to that inflation by name. People want to jump on this stock because they don't want to be left out. It's a big deal to have a New York Stock Exchange IPO. They don't want to do that. Other is loyalty. Some people are just so loyal that they want to have that price. Now, do you think if it's worth this price, it's important in there? You just have to kind of figure out where it's at in the long run. If they lost, if you look at here, they did price this pretty well. You see that it went from about 55 and then it dipped down. You see that to its actual value of around $40 a share. The market always wins, okay? And it's kind of in that saying that, look, the market saw that and they said, look, I see this, I have this price here, and then it has gradually increased because we saw that revenue increase like they did in their growth, okay? And the price of the stock has gone up since then. But if you bought that stock at 55, you would be sitting really pretty at $168 a share. But here you see that the price went down because there was loyalty bandwagon, inflation by name in there. They probably could have came up a little bit higher. It didn't take a big spike. But this is great news for Ferrari. Not so great news for investors. Great news for Ferrari because they didn't leave money on the table. They sold their stock at the highest market that they could have gotten for it, and in return were able to profit from that. And that's why you're seeing that the price is of $168. Where you don't want to see is a company having a price of $40, and then as soon as the market opens, the price of that stock goes to $200 a share. That's awful. Only investment bankers win on that part. All right. The last question here, guys, is identify and integrate biblical principles. You have done a fabulous job in this class doing this. I'm continuously proud of you. Keep up the good work on this. I'm proud of you in doing that. All right, if you have any questions or concerns, I am here to help. Make sure you use my chart here to help you with that $38 a share so that you can go in there and tell me what you think it is as well. Good job in the class. Questions, concerns, I'm always here to help. Email or phone call away.